A major oil producer is preparing to exit one of the most influential energy alliances in modern history, at the same time that a critical maritime chokepoint is effectively unusable. The Organization of the Petroleum Exporting Countries has coordinated supply across its members for decades, but now the United Arab Emirates is signaling a departure that could reshape how oil reaches global markets. With roughly 14.5 million barrels per day of production in the Persian Gulf currently disrupted, the issue is not limited to pricing volatility. It is about control over supply flows in a system that depends heavily on coordination and uninterrupted transit. To understand the implications, it is necessary to examine how OPEC functions. Established in 1960, the organization's central mechanism is the allocation of production quotas among member states. These quotas are intended to stabilize prices by limiting oversupply during weak demand and increasing output during shortages. The UAE joined through Abu Dhabi in 1967 and became a full member after forming as a unified state in 1971. Over time, it has consistently ranked as OPEC's third largest producer, behind Saudi Arabia and Iraq, giving it both influence and constraints within the system. Those constraints are central to the current shift. Over the past decade, the UAE has invested heavily in expanding its production capacity, aiming to raise output beyond levels typically permitted under OPEC agreements. This has created a persistent tension between national capacity and collective discipline. While OPEC prioritizes market stability, individual producers seek to maximize revenue, particularly during periods of elevated prices. Exiting OPEC would remove formal limits on UAE production, allowing it to align output more directly with its own economic objectives. At the same time, geopolitical conditions are restricting the physical movement of oil. The Strait of Hormuz remains one of the most critical transit points in the global energy system, handling a significant share of seaborne crude exports. Current tensions involving the United States and Iran have disrupted normal operations in the region. Following failed diplomatic engagement that included halted efforts involving Donald Trump's envoys Steve Witkoff and Jared Kushner, the situation escalated. A U.S. naval presence has effectively limited Iranian port activity, while Iran has indicated that it may interfere with outbound shipping under certain conditions. These dynamics are already reflected in price movements. U.S. West Texas Intermediate crude has exceeded $100 per barrel for the first time since April 10th, reaching nearly $102 in early trading. Brent crude has climbed to approximately $113. Earlier in April, prices had declined significantly after a ceasefire announcement reduced perceived risk, with Brent falling more than 17% before rebounding as the situation deteriorated. This pattern illustrates how quickly geopolitical signals are being incorporated into market pricing. Financial institutions are adjusting their forecasts accordingly. Goldman Sachs has revised its fourth quarter projection for U.S. crude upward from $75 to $83 per barrel and increased its Brent forecast to $90. Citi has taken a more aggressive position, suggesting that Brent could reach $150 in a high-stress scenario, averaging around $130 through the third quarter before moderating. These projections reflect expectations of a slower recovery in supply, particularly if Gulf exports remain constrained beyond mid-year. The effects extend beyond crude oil into refined products. Jet fuel supplies have tightened, leading airlines in Asia and Europe to reduce capacity as operating costs rise. Analysts at JP Chase anticipate further weakening in jet fuel demand as carriers continue to adjust schedules. Gasoline prices in the United States have reached an average of $4.18 per gallon, marking the highest level this year and indicating that upstream disruptions are feeding into consumer markets. The The geopolitical context remains complex. The UAE maintains strategic relationships with Western economies while also positioning itself as a flexible supplier capable of responding to market conditions. Its potential departure from OPEC does not indicate alignment against specific actors, but rather a recalibration of how it manages production policy. At the same time, US-Iran tensions are shaping the operational environment across the Gulf, affecting not only Iranian exports but the broader regional logistics network. One possible trajectory is a controlled divergence scenario. In this outcome, the UAE exits OPEC but increases production in a measured way, aligning supply with global demand without triggering a sharp price decline. If the Strait of Hormuz reopens within a defined time frame, additional supply could stabilize markets. This would allow the UAE to operate independently while maintaining a degree of predictability in global pricing, and OPEC could continue functioning with reduced but still meaningful influence. A second scenario is more disruptive. If the strait remains constrained and the UAE accelerates production beyond what can be transported through alternative routes, the result is a persistent mismatch between supply and delivery capacity. Prices remain elevated due to logistical limitations rather than actual shortages. At the same time, OPEC's cohesion weakens further, potentially prompting other members to reconsider their commitments. This fragmentation could lead to a more volatile market environment where coordination is limited and responses to shocks are less predictable. There is also an intermediate scenario where partial adjustments occur. The UAE could maintain informal coordination with key producers even after exiting OPEC, while the strait operates at reduced capacity rather than being fully restricted. In this case, the market would experience elevated volatility, but not a complete breakdown in structure. Pricing would remain sensitive to both production decisions and transit conditions, creating a hybrid system that blends coordinated and independent behavior. The broader implications extend into macroeconomic policy. Oil prices influence inflation rates, trade balances, and central bank decisions across major economies. A sustained period of high prices, particularly if driven by supply disruptions rather than demand growth, complicates monetary policy. It increases input costs across industries, reduces consumer purchasing power, and can slow economic growth in import-dependent countries. At the same time, higher prices shift leverage toward producers with flexible export routes and diversified infrastructure. Countries that can bypass constrained choke points or adjust supply quickly gain strategic advantages. Conversely, producers heavily reliant on specific transit routes face greater exposure to geopolitical risk, reducing their ability to respond effectively to market changes. What emerges is a system in transition. The combination of a key OPEC member potentially exiting the organization and a major shipping lane facing disruption introduces uncertainty that traditional market mechanisms are not designed to absorb efficiently. The balance between coordinated supply management and independent production strategies is being tested under conditions of constrained logistics.